So, they said by this week, latest by Friday, all the problems will get resolved, and they advised each faculty who is involved in this to make sure that that does not cause any inconvenience to the students. So, during this week, if you have some peculiar problem, please let us know. We will try to do one to one by sending in emails and so on like that. But by Friday, hopefully that problem will get resolved. If not, let us see what happens at that time. That is first announcement. Second is, I showed you the plan practically every week what we will go through the course. So, there is going to be a small change for this week. I am not going to be available for the class on I think Wednesday and Thursday, these two classes. I am going out of Chennai, and Professor Narajan will fill in, and he will bring in the topic of global chemical industry, Indian chemical industry, the situation connect. I just spoke to him and requested him, whatever we have been going through in the past with respect to cost, nature of the jobs, nature of competition, including this finance, you can relate it to the context that he goes. Normally, like I said, in usual class, we first come from that, then I realized it, sometimes it goes above your head listening to all this global industry. Therefore, we switched this year. So, I hope please be clear to sort of refer with him when he talks, what is the link if there is. So, that is the two things there. Okay. With that, we are on to this. Last class what I said is balance sheet, which is basically who provides money for the company's operations and how the money is used, that is a snapshot. Then I also talked about the profit and loss statement or the income statement as it is called. The balance sheet is a snapshot at a point of time, just to repeat it. At one point of time, if you summarize the company's affairs, who owns how much and where is the money invested, you will get the picture. Then the second statement, which is the income statement or the profit and loss statement, is over the period of that whatever period, you can define 3 months, 6 months, 1 year, what all the company has done, and therefore, what is the result, that is what comes in the second. And the linkage between the two is, if at the end of that period, if you made a profit like this, the balance sheet it will show up. The contra is, if you made a loss unfortunately for that year, it will also show up in the balance sheet. So, that is the connect, and I gave some example. In that example, it ended up like that. Beginning of the year, somebody had an asset of this, split between two kinds of owners. One is the real owners who put that money, and the secondly people who give loans. And there is a difference, significant difference between the class of these two investors, which I will talk about in the next couple of slides. End of the year, the overall assets of the company increased because you made a profit of whatever it is, and we discussed jovially who does the profit belong to and so on like that. Here is where a slight technicality, I did not get into the class. In this class, I will start the technicality. The technicality is, in terms of the profit, first let us say profit, quick update, which is revenue minus cost, right, from a previous lecture. I used a terminology called profit before interest and tax. This is very common among Indian companies. PBIT is the acronym that is used. In US companies, it is sometimes the same thing is called as EBIT, earnings before interest and tax. It is practically the same thing. We call it profit. These guys, for some reason, they do not like the word looks like that, therefore, they go for earnings before. It is the same thing. So, basically it says you have taken care of the revenue for that period, all the cost that is involved in making the revenue you have subtracted, with two exceptions. One is the interest cost you have not subtracted, and the tax you have not subtracted. Interest cost is the cost of the funds that people gave you, the people who gave you the loan, that category of fund providers, their charges are interest, and of course, government always has a charge on us, right. So, that is the tax. Then from this PBIT, the first item to go, if you take away the interest, then obviously it becomes PBT. So, the interest is removed. Then you also remove the portion belonging to the government, which is decided by the tax laws at that point of time. You get profit after tax. Now, this profit after tax number is the one that really belongs to the shareholder owners. So, when we say profit, it is a very loosely put terms, and one of you pointed out saying that let us be very clear. So, I just thought I will add this. Profit is a little bit loose definition, you get the idea, but the precise definition is it should be profit after tax, after you pay the interest and you pay the tax. This is what it is. Now, there is a sequence about this. I did not say PBIT, first remove the tax, then remove the interest. There is a reason for which I put interest first, and then the tax next. This is because in almost all countries the tax is charged after the interest is removed from that. That is why the title of the slide says it is the primacy of claims. In the claims of the company, after they do their operations, they get some surplus. Who have got the claims? There is a accepted legal first priority, second priority. The first priority of course at this stage goes to the people who provide the loans for you. Then the government chips in and says I have to take my share, and whatever is left goes to the last category, which is the owners. So, owners actually take the last priority in terms of the charge of the company. So, this is different from, therefore, now in the previous slide I said there are two kinds of people who provide their own money, owners, the others who provide like a loan. You can see the difference between the two, gets first priority, what not. So, that is what it is. Now, this money which is PAT, which is now we agree that it really belongs to the providers, the owner's capital. What do they do with that? Two things they can do. One is they can just give it to me, take it at the end of the period, or they can say let the company, is my company after all. So, let the company retain that money for a period or anything in between. So, all combinations are possible. So, the one that they choose to withdraw is called dividend, which is paid as a percentage of the share value, and the rest what they retain is of course retained earnings, and this retained earnings is actually the one that goes into the profit and loss statement. So, in my previous slide when I had made it, I will now show it in much more detail in this slide. For example, in our example I had shown, now I am defining profit after tax, that 75 rupees what I showed is actually the profit after tax. That is why it goes into the balance sheet added. So, if the tax is 25 rupees I added, why I added 25 not 40 or 50 I will come to in a minute, but take 25, then I get profit before tax becomes sum of these two 75. Usually the tax rate is of the order of 25 to 30% on the PBT value, which is why I took that number as that. And then now somewhere I said 400 is the owner's fund and 600 is the fund providers, loan fund providers. Usually the interest rates, let us say it varies, right, we all know the interest rate varies. So, for that 600 I have taken the interest of 45 rupees. So, which means basically I am taking something like 7.5% interest on the loans. So, that is 45. If I add that also, then that business during that 1 year made profit before interest tax of 145. So, that is the definition. Now, we will slip back to, yeah, this one. Just coming to that, 1 minute, only this last two I have got it mixed up. So, I will now explain it in a minute. Yeah.
So, if you were, so the budget which is mixed for the next financial, does it come out of the cost or does it come out of the money which is retained in the business?
Okay, two questions. First I will answer the first question, then I will come back to that. Okay. So, getting back to why all this we are discussing about is that there is something called financial performance of the company that we have to go through. This is where, like any mechanical systems or any system, the efficiency is an output divided by input, that is what we, whether it is energy efficiency or material efficiency or whatever. So, here it is a financial efficiency of the company's operations, therefore, there is an output divided by input. We have to find what is that output and input in same consistent units of measures, right, it should be the same consistently. So, the output is usually taken as one of the two, either that PBIT, which is profit or surplus or earnings before interest and tax, that is one kind of output you can take, or you can choose the second kind of output, which is profit after tax for during that period, whichever, this is of course dependent on the period in which you are analyzing it. So, after you first make up your period, you find out the output from the operations, which is in terms of either PBIT or PAT. Let us say we get these numbers. Now, the slide which I showed you just before has both the numbers. Now, we need an input to get the efficiency. The input is usually saying that it is a financial measure, therefore, you should know what are all the finances that has gone into the operations of the company during the period of time. It makes sense, right? You have something which is all the money that has been invested in that company up to that point of time. Now, what is the meaning of all the money that is invested means you have to go to the balance sheet and find out who has got claim of what in this company at this point of time, which is you have to find out what is the owner's equity, you have to know what is the loans taken at that point of time. Sum of these two is the total equity, total funds employed by the company. Now, you ask that question of what are this defined. So, now we have two outputs defined, we have got two inputs defined. Now, we can take the ratio to our heart's content, one from here and put it. The two most commonly used indicators are, one is called return on capital employed, ROCE, that is the acronym more or less used. As the definition says, it is return on capital employed. So, what you have to know is what is return. For this case, the return is taken as PBIT, numerator, denominator is total capital employed. In a way it is logical, because at this point of time the surplus you are not decided to whom it belongs and so on, excepting what we have done is we are thinking there is a claim from the interest guys, there is a thinking that there is a claim from the government, but before that whatever has got has been taken as one basis, and all the money with irrespective of the sources that has been there, we take it as a denominator. 1 divided by there as ratio is what is the one very commonly used indicator, ROCE. The second is in a little bit more narrow selfish way of only the owners of the company, leaving the other finance providers into that. So, which means denominator note is very clear, it should be only the owner's equity, and therefore, the numerator what we do is that we remove the interest part, we remove the tax part, because these two guys have taken away there and I get only the last claim on the money of the company. Therefore, we take profit after tax divided by the owner's equity. So, this is the two definitions of that. Now, with this you can answer this question. I have put the same numbers, worked it out. Now, for ROCE we have to take the total profit without deciding to whom it belongs, that is in this case it comes out as 145, and the denominator there is a usually a small arithmetic in this, it changes with the time, right, because the total capital employed always varies with the time. Therefore, I said you have to take a snapshot at a point of time. Do you take it at the beginning of the period, in which case there is no profit has come. If you take it at the end of the period, you have got the full profit, but it need not be the same capital all throughout the year. So, for as a compromise, actually there is a mathematical formula that very simple, you can take weighted average, you can do whatever, there are some conventions companies follow. So, I have taken an approximate saying that 1050. So, with that for this particular hypothetical example, the return on capital employed is 14% and the return on net worth, which is a more narrow definition taking only the owners into account, 18.5. It will always come like that, always in any company, so long as you are making profit, that is, because you must have a positive number. If you have a negative number, it is difficult. So, if you have a positive number, the total net worth return will be higher as compared to return on capital employed. The reason for that is very simple. The denominator consists of two parts, one by the owners, one by the loan providers. By a common accepted convention, the tax is paid after the providers of loans money is taken away, which is why this thing works out like that. But this is all accounting niceties, let us ignore. So, important point to remember is, for financial evaluation of a company's operation, after you go through the balance sheet and if you go through the profit, you will get two numbers, which is return on capital employed for the total, or very narrow definition return on equity or net worth by the owners. Now,
Sir, how did you calculate the PCE average?
beginning of the year 1000, end of the year supposing this PAT 75 belongs to the company. So, it is we have to add to the owner's equity, right,
It will just be directly.
because everybody has taken their share, what remains is 75, the 75 has to be added to the owner's equity. So, beginning of the year it was 1000, end of the year it will be 1075, average 1050. Okay. Now, this is a very important slide. Why this? An engineer has to remember all. This is all you need to know. By the way, there is no high finance compared to more than this. Rest is all arithmetics, Excel sheets. You have to know, because here is an example. You had some money with you and you want to make use of that money. You can do it in several ways. You can buy something, consume it, whatever it is, or you can decide to say something called investment, which means basically what you are saying is you are setting aside that money, you are not immediately making use of it, setting aside something else and hoping that will give you little bit better in future. As simple as that, right? Investment is just you keep our current consumption a little lower, whatever you are otherwise you would use it up, you delay it, you put it in some other avenue which you expect will give you a little better compared to what you had with that. Here are some examples given in various degrees, various options available to you. The difference, if you really analyze each one of them, we will not go through every one of them, but take some of them. What you would really look for as an investor is, you must get something better than what you have. That is a normal expectation. That is equivalent to return on investment. You get something better than what it is, it is a positive number. At most, you should get your money back when you want it. That is another thing. So, if you know with that two guidelines, if you go through, let us say you deposit your money in a fixed deposit in a national bank as an example. I put nationalized bank because there is a bit of a security. Arey, kuch bhi ho gaya, to finally the government nationalize. So, you will get their money back. It may be delayed, whatever it is, but at least because it is a country sovereign, you will get it back. So, you get some assurance, that is why I put nationalized bank. Then I said one class of investment called fixed deposit. Now, if you go through the fixed deposits, they say for a period, you can put it for 1 year, 18 months, 36 months, whatever. Yeah. They will give an assured return, and usually these returns are not sky high, they are moderate, let me say. So, for the guarantee that your money comes back to you at the end of that period, you are willing to accept a slightly lower rate of return. So, that is one. The other is go to invest money in buying shares of a company or purchase of a land or property, that kind of a decision you take. Now, why do you do that is, at least in the case of the share of the company, you may want to use it because they provide some returns to you. Periodically the companies issue dividends, what we saw surplus given on to the owners, and occasionally they reward in different ways. They give you something called bonus shares, which means you do not pay any money to the company, but they treat you as if you have got a share, and on that share also you will get dividends for the future. So, that kind of a return. So, you are interested in that, you can get back. But one interesting question for all of you is that I told you the class of investors, the guys who give loans as money and the guys who actually invest called owners, the difference is the loan guys can give to the company money and then say the terms will be, I will give you this money for a period of this time, at the end of it you must give me in this installments. Like that, the return of the money is built into the contract. Like you have got a fixed deposit, the bank cannot say I will take the money from you, okay, I will pay you interest. Wait a minute, when will I get it back is a question that comes. Similarly, all loan providers, when they get into a loan arrangement with the company, they also kind of understand and sign off a contract, which is the original capital whatever has been given by them, in what manner it will be returned by the company is not guaranteed, is at least contractually assured to you. So, you have got some hold on the company, they are bound to do like that. Whereas, the people who invest is like a one-way traffic. Rarely a company, you can go to the company, hey, I got your shares of the company, can I get the money back, I am in need of some money. There is I am not sure, it happens only in one kind of a situation, it is a very rare occurrence, it is not a common thing. On the other hand, there is something called a secondary market, which is buying and selling of shares of all companies in the stock exchange. This is just a independent world, it is a wonderful world that goes on, where you can go and then find out for the kind of, for the company that you have the share on, what the market within quotation, which is basically what everybody else thinks the value of that company at that point of time is. And this number, if such of you who have read things like Financial Express, Economic Times, or even these days digitally, somehow goes even during a day. This is a puzzle I have never understood. I mean, you are used to gradual value up, gradual value. This is like, from morning 10:59 to 11:02, there is a 14%, 15% change in the share of the company. So, point is, investment in shares, particularly as owners, is much more riskier, because you never know whether the dividend will come, because it is after all a last charge. After the profit of the company, after this you get it, that is one. Secondly, what happens to the value of the shares that you hold itself is a moot point. Third, final detail, which is when you want to buy the shares of the company, normally what we think, at least I used to think, I do not know, you guys are all financially more savvy than I am. I thought I got 100 bucks, I want to go and buy a share of the company. Hey, give me a share of the company for 100 rupees, means they will give me equivalent to 100. It turns out they give it, but they say one small thing, saying that, you know what, I will take 100 rupees from you, I will give you one share. Then I think, oh, the value of the share is 100. No, wait a minute, it is not as simple as that. The value of the share we consider as 10. The 90 is a premium. What is this? In other words, the worth, the dividends, all that you will get paid when the company makes profit is not another 100 rupees that you chose to buy, it is on that 10 bucks. Then what is this 90? It is called share premium, and the market price at that point of time can be 80, can be 120. You got the point? So, there is a bit of a googly here. So, the thing is, it is risky, keep that in mind. How does it affect motivations? Back to our jobs. This finance must all finally make sense to our jobs, right. So, the jobs is owners, which are the major, and especially major owners are of all kinds. You know, you have find that there will be retail owners, like my dad was a bad example, because he never invested anything, he never had money to invest in anything. But okay, let me take one of my rich uncles. This guy speculates, okay, that share market is happening like that, he puts money, one kind, but his investment will be 300 shares, 200 shares. Then there are big time guys, dadas. There is one Junjunwala who is supposed to be the king of share market in India. He deals in millions of shares. And then there are pension funds, and there is LIC, for instance. There are institutional investors. All sorts of fellows are buying and selling shares in this. Now, their motivations can be very different. And if their motivations are different, they are going to pass on their motivations and expectations on to the management of the company, and therefore, the management of the company will pass it on to employees like us. So, that is the context in which I am saying this. So, the two things that usually shareholders want is, they want a reliable and reasonable RONW. This is where that return on net worth comes, because they are only interested in, they are not interested in ROCE. I mean, that is all for the company, but what do I get is that for the shareholders relevant data is RONW, they look at it reasonable, reliable. Now, what is reasonable? Varies, depends, and reliable, yes, which means that it is not 1 year I get a fantastic return on net worth, the next year we come back and say, I am sorry, there is a loss. So, they just expect if you have something keeps going up, preferably like this, but at least like this, definitely not like this. That is what will be the shareholders' expectation is. Secondly, and this is a very key point also, what is their exit options for the shareholders? Like I said, you can't go back to the company and say, I want to trade my shares back, please give me money back. That does not happen. Therefore, they go to the secondary market, which I said the share prices are anybody's guess. Just there are lots of theories about it, and some of you who choose a finance career, God bless you, you will find that there are PhDs written about this, how the share value of a company is determined. You can take 247 variables and try to do a statistical analysis and find out whatever it is, but the net is one does not know, excepting it varies like heck. Okay. So, they are also looking for some exit options at some point of time. When they decide it is quits, they can go to the market and dump the shares at that price. How does it affect the company? Company is not paying that, but it affects the company, because if lot of people decide to dump the shares, recent examples you will know, it coincidentally happened in newspaper, go and ready Hindenburg, lot of people went and dumped the shares, then the share market prices drops down significantly for that reason. Because everybody gets panicked, hey, kuch ho raha hai yaar, we should be very careful about our money, and then they try to sell it off. There are too many sellers, too little buyers, confusion can result. And still, how does it affect the company? Then the ability of the company to raise further money in future will get severely compromised. And how does it affect the employees eventually is, if that is the case, then the behavior, attitude will be, I think we should be doing cost cutting and 15,000 jobs have to be let go. So, this cycle happens. So, this is the motivation why engineers should have a reasonable track, not on share market value, but at least on what is your return on net worth, return on capital employed, because these are scientific figures, established, published, available information. Loan providers on the other hand, what is their motivation will be, they want to make sure at least their interest portion will come, because they already have a contract that the money will come back to them at that point of time. At least a paper they have got saying that company, when I approach you at this period, you are supposed to give me my money back. Of course, there have been Malayas in the world, and then a lot of banks which went and said, I have got this paper, yeah, keep it for some more time. So, this is what happens. Therefore, this influence our jobs as engineers in terms of the relentless focus. It will come back to on output, costs, and what is the ideas that we got for future improvements, because the present operations one will try to make it as profitable as possible, and the future operation also they would like to keep it as profitable as possible. So, that is how the ROCE and RONW engineers must take some interest, that whatever I told you, that is all the concept, rest is all gimmicks, little bit sophistication here, but in principle that is what it is. If you know where your profits are coming from, if you know what is the total capital that the company has employed, both of which is available in the balance sheet, you will get to know where you are headed. Okay. And the trend is to compare it not your company, because your company is, everybody thinks they are unique, and as human beings we are all unique anyway. Our 3.2 billion DNA fragments is unique from one person, even among twins it is different, but usually in reality there are a lot of similarities, comparisons you can make. So, the tendency will be if your company is one kind of a product, market and so on, there are other guys also operating in that. So, the people with some financial background etc., and you yourself can take some interest and compare, how do we compare with somebody else who is in a similar line of business in terms of this financial parameters, to see why not. So, that is the value of this. Just a summary. The last is just a caveat I put. I am not a great believer of this market capitalization word that people goes around, but it is a huge, by the way, it is a huge setup. Like I said, PhDs are getting written about market capitalization. What is, I will just say what it is and then move on. Market capitalization is at a particular point of time in a particular market, New York Stock Exchange, Bombay Stock Exchange, you define at some trading house at a point of time, because it also varies from morning to evening by the hour and minute. So, you pick up something there, that is value of your share as somebody says. Then the total shares that is available in that company at that point of time is a historical fact, number of shares I mean. So, you take the number of shares, you take the value as reported at a point of time in a location by somebody, multiply one by the other, that is market capitalization. There is a huge craze that goes after this market capitalization. Like we say, oh, yesterday Warren Buffett lost $40 billion, Bill Gates got $30 billion. Take it with a pinch of salt. It is not as if these guys have lost that. It tends to divert your attention as engineers from the basics. Basics are making a product, doing a service efficiently in a cost effective manner, selling it as much as possible, that is the basics. Okay. Now, job of a financial officer is, this guy is very powerful in companies, CFO, big shot, next to only to the boss. Okay. Sometimes he is the boss. Now, his role is he has to continuously measure the performance of his organization in money terms, and with key people he has to share it, right, simple. He is the one who is supposed to keep track of the financial performance. He is not an accountant, by the way, he could be an accountant, but not necessarily an accountant, because accountant does historical record keeping, but getting from record keeping to financing, projections etc., becomes a financial officer. So, he has to kind of keep track of the performance, financial performance of the company, and then keep key people. The key people are outside world is all the time interested, especially for a public limited company. Everybody is looking at you all the time. Anyway, 3 times, 4 times a year you have to compulsorily publish it. Rest of the time people will come and talk to you, or some of these hyper ego guys want to go and talk, whatever. So, this kind of a thing. More importantly, he has to share that information with employees, because eventually these are the guys who are creating whatever is happening because somebody is doing a job. Regretfully and unfortunately, it does not happen very often as much as the first, which is going to outside and telling about what the company is. Keep that in mind. It might change, hopefully it changes, but keep that in mind. That is the job of a financial officer. Second is, when a new idea comes about the suggested options for the company, why can't the company be doing like this? Why can't we invest into this product? Why can't we go into that technology? Like that various, why can't we futuristic proposals come up? This guy has the responsibility of doing the financial evaluation. Financial evaluation being, if I do this, what happens to the anticipated return on capital employed? If I do this, what happens to the anticipated return on net worth? That is what that means. It is a kind of a projection for the future based on some input information. And that input information comes from the rest of the operating colleagues, marketing department, technology department, manufacturing department, the whole works. They all gather together, make some scenarios, and these scenarios are converted into financial projections, and evaluation is done by the CFO. And of course, the last part of the job is, if it is accepted that is what we should do by the company, then it will require some funds. Like we have a good idea for energy efficiency to be improvement. We want to invest in a new plant making certain kind of a product. This requires money, and that money to arrange it becomes his responsibility, including the mix. How much of that money should come from equity, if at all? How much of the money should come from external borrowings? That decision he has to make. At that point of time, your second question, Arundhati, comes in. Whereas, after you put all that money there, what is it return? And you said that looking at your cash flow situations, how much money surpluses you have been building up and where you are keeping it, you can make an intelligent decision whether you should borrow more money or you should use your own money given the situation of the project. So, it is a very interesting, very challenging job. Some of you, in fact, I know several of my fellow chemical engineers went into finance and are doing a damn good job. So, that is the nature of the job. But what we need to keep it in mind is, in order to perform that job very well, apart from their own person's capabilities and knowledge and talent, he also relies a lot on the information provided by a lot of other people. So, that is what we have to keep it in mind. Now, you can do some trial. You can now, with this background, pick up some companies which you are interested in. If it is a listed company, it is better, because many companies sometimes they are privately owned companies, they do not have to publish it in the public domain. Privately limited, if you have a private limited company, you are not obliged to share any information with anybody, but mostly I think we will be interested in public limited companies, and all public limited companies will have to do this. So, this balance, the annual reports will be available. You can go to the finance section, download the report and read it, and look for return on capital employed, return on net worth. Usually the trends and graphs and all that is given with the management's explanation of why it is like this, why it is like that, what are they expecting to happen in the next couple of years. Lot of stuff will be available there. When it is worthwhile to keep reading about it. Now, back to our entry level jobs and our career growth. With this, now you are suitably, apart from your technical skills, you have got what good understanding of finance is, that the engineer's role is maintaining profitability of current operations is a very important role. After all, if you join a company, mostly you will join a running company. I mean, some of you may join a startup, but very soon you will want the startup to become a running company yourself. So, in a running company, how to make it profitable will be a major role of the engineer, and the way he does it is of course very simple, either increasing output or reducing the cost, or introducing a new product which is having low cost, or investing in a new technology which makes a product at a low cost, so on like this. So, engineer's role is very fundamental, and especially in a chemical process industry, and I think we discussed in the first class, chemical engineers' virtue in my opinion is, as compared to any other branch of engineering, is our ability to meld with other branches of engineering and contribute is much better, because fundamentally we are the guys who talk about materials and energy balances, and in the world there is nothing, no third. So, whatever, whether you are electronics, avionics, software, whatever, eventually it will come down to quantification of input output in the form of that. So, our training helps us to keep a clear mind in mind, and therefore contribute to maintaining the profitability. So, that is what, keep that in mind for that. of course, the idea of getting financial concepts is tomorrow if you have to think of an improvement, technically first you think about there is an idea that you got and you want to implement that idea, you will not be compromised of having to go and ask somebody why the idea should be implemented, why the idea should, because you will need money for that. You yourself will be able to make out a very strong case about the viability or the profitability, likely profitability of that idea. So, keep that in mind. We have discussed this. Other role that the engineer has got is everything is uncertain in life in a way. If you see, everything is uncertain, even the things that we think is 100% certain is uncertain sometimes. The margin of uncertainty can be small, but nothing is precise, particular on the dot. So, the engineer has a role of increasingly as you get experience able to quantify in reasonable terms what is the likely uncertainty factors. This is a thing that comes only from engineers, because you are basing it on some facts. Otherwise, there can be naysayers. You go and ask somebody, I do not think it is, this kind of a thing people say, do you think electric car will be launched in the next 10 years? No, I do not think so, because there are tax structures, some fellow will say. Some fellow will say, no, the costs are very, very high, very unlikely. On the other hand, somebody may say, I am telling you next year 40% of the cars are going to be electric in India. But if you are an engineer, then for behind each statement, you will have some wherewithal to go and check what are the assumptions we are making it to make it happen. So, that is what is the role of engineers, to also quantify the risk and do something about the risk. It is not as if I give a number of risk and then say, here a small diversion I really have to make. Many of you, some of you at least, would have learnt about the major financial crisis, the major last financial crisis that shook the world in 2008, 2009, right. Some of you must have heard about it. It started with a collapse of a finance company called Lehman Brothers, and then everything spread, big time news. Now, finally it turned out the origins are, this company was doing let us say mortgages, which means I give money to somebody else and tell him over a period of time you pay me back, as simple as that. You loan somebody and then over a period of time he is supposed to give it back. Of course, you build in your interest, return, all that into that. They chose housing market, which means there is somebody, you go and tell him you want to build a house, or you want to buy a house, or you want to improve your existing house, something related with the house. Here is money, take it from me. After some point of time, like this, you give the money back. Up to now it seems to be okay. Then packages were made out of this deal with a lot of financial sophistication built into that. And then this package loans, which is, it has got n number of loanees with n number of cash flow streams, was packaged, split into various forms and go to another investment company. Now, we are not going to the fellow who is building a house or modifying a house. You are going to an investment company and telling him, I have got an investment option. If you invest in this, you will get this kind of a return, and number is given. Of course, in this matters there is no guarantee, because it is not a loan he is providing. He is investing like an equity owner. So, he takes the business risks. Finally, no one asked, what is the chance that the guy who took the loan from you in the first case, that he will pay in time? Of course, he is not a cheater, some could be. His ability to return the loan depends on his situation at that point of time. Nobody asked that question apparently, and that led to, at least if there was an engineer, there were engineers, but I think for some reason they chose not to exercise their current. If you are an engineer, you will know the fundamental assumption on which you are making a new product, new technology, everything. You will know what are the chances that something can go wrong, because in our life we have seen things go wrong, mechanical systems fail, things take longer time, whatever. So, last couple of slides. So, the engineer's role in investment decisions is to know what are the chances of success, and also what are the chances that there can be some setbacks, and provide this technical information along with the cost information to your finance colleague, so that that person works out using arithmetics, Excel sheets basically, something called discounted cash flow, you can all read it up. It is just not, it is very simple. If I get 100 rupees today, it is more useful to me than getting 100 rupees next year, naturally, right. And what do you do? How do you reflect this? Is that you take a factor and then say, let us say 10% discounting factor. If 100 of today is only equivalent to 90 of next year, and so on. Like that, now you have got a whole lot of cash flows, use this discounting factor here and there in massive looking spreadsheets, and finally you will get some value. That is how future value of the company's valuations, which I spoke about, is all derived at, and for some reason still I have to repeat, if that is the case, why the valuation should change between 1241 and 1222, I have not understood. Anyway, that is what it is. Now, practical example of a new investment I talk about. Let us say you are a engineer concerned with setting up a new caustic soda plant. Some of the numbers are given here. You will know the capacity of the plant, and the capacity of the plant choice itself you will be involved. Why is it 100, why not 50, why not 250, you will be involved in that choice based on logical analysis, and then you will be asked, like I said, how much does it cost to set up the plant. Here is a number, and remember how much of hassle you have to go through to get that number. Remember that sheet: land, buildings, roads, site development, plant and machinery, equipment, valves, instrument, the works you have to do, and finally you get to know, including contingency and escalation for the future unknown, around 300 crores of money will be set required for this 100 tons per day plant. The BL is battery limits plant. That means you define the scope. You somewhere you have to say this is included, this is not included. So, for the items that you have included in this called battery limits plant. Now, you have chosen a technology called membrane process technology. More of this will come in the technical classes. Now, should we go for making this plant or not? Will be like this. Now, you will have the variable cost worked out. Here is a sheet which gives a variable cost, items of use, salt, electricity, blah 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 blah. If there is a byproduct negative credit. Then fixed costs, how many employees, repairs, maintenance, all that you will put it. Selling price, you will get some idea from the market, including the fluctuations up and down, and you will give an Excel sheet which is 1 year, 2 year, 3 year outflow is taking place because you are setting up the plant, money is only being spent, nothing is coming back. 4th year, 5th year, 6th year, 7th year, up to some period. If you put 20 years of chemical plant, by the way, have expected to have at least 15 years of life, but after 15 years whatever you put in the discounting, it will get ignored. It turns out that whatever reasonable discounting factor you take, after a couple of years that does not add to much value to them. So, our time frames are all 3-4 years of plant construction and about 10 to 15 years of actual running of the plant. You make hell of a lot of assumptions, but you will know what the assumptions are, that is the point. You will know the assumptions like better than anybody else. Give it to your finance colleague, he will evaluate it and come back and say, against the expectation of the shareholders or the finance providers, ROCE and RONE, this particular investment turns out to be like this or like that, he will work out the number, and then finally a decision will be taken whether to spend money or not. So, that is what it is. This is for big investment, 300 crores, new plant and all that. It is not that every day you will be doing this, right. Occasionally there will be a lot of running the plant continuously, efficiently, that situation. Now, if you have, let us say, a plant which is already producing caustic soda and selling, you are meeting the market requirements. Here is a guy, but it is based on a different technology. Here it is called mercury cell. Here also more of that I will talk about later, mercury cell. Mercury cell technology you have, some guy comes and says, I think we should switch over to something called membrane technology. Running plant, you are switching over. How do you evaluate? Should we do, should we not do? Same principle. In this case, delta incremental cost, delta revenue, one with the other, you calculate it. This is an assignment, graded assignment, first time. The first one was not graded. I said 100% everybody is good because it is your future, your dream. This assignment is to help you understand the concepts of whatever we have talked, to put it into a piece of paper. Here is the assignment. This is a situation where there is a rotary dryer which is working in your plant. I think I showed the sketch of a rotary dryer also, right. Combustion air, primary air goes there, product solid is coming, drying, hot gases, cyclone, blah, blah, that you can. Now, this is 25,000 nm cube of gases are flowing at temperature of 200 degrees of that. A little bit additional information, they say this gases contain SO2 because the fuel that is used for burning is diesel, it cuts some sulfur. So, that sulfur carries through. Some fine particle matter is also there. In spite of the cyclone, even cyclonic efficiencies are 96, 97, 98%, right, depending on what type of cyclone. Now, some guy comes and says, I am on a cost drive, right, I have to reduce my cost, this is what its goal. Then 200 degrees centigrade exhaust gases are going up, something should be done about it. For example, recover the heat from there. Now, think of a flow, some flow diagram you are supposed to think. With this scenario, think of a flow diagram to implement this heat recovery scheme, only the flow diagram, but try to make it as complete as possible. I do not want P and I diagram, which means that is horrible, it will take weeks, it is not worthwhile also, because flow diagram is sufficient. At least it should reflect all the key pieces of equipment that is involved in this, along with some estimates about how much does it cost to run those equipments, that you should be able to say. Let us say if you provide another fan in between, you should be able to say what will be the horsepower of that fan, that kind of a thing, size of the fan, this kind of a thing you should be able to say. Do not worry about what will be the cost of that fan, etc., that is irrelevant. That detail comes from P and I, we do not go there. Then after writing the flow diagram, you sit back and say, I got the flow diagram, if I have to go to the next step of saying, should I implement this or not? Think about that and write your steps. Clear? No need for getting any answer for this. It is just that you force yourself in a situation like this, come up with a scheme, at least visualize the scheme in terms of a flow diagram, and on the flow diagram after you finish it, next step is, if I have to evaluate whether I should go ahead with this idea or not, what should I be doing?